All right, so let's begin the show. And yes, the magic of SIP. We've talked about it all, you've read about it all, and long term investors have also witnessed the magic of SIPs. But for all those investors who are yet to believe in the power of SIP, this segment is definitely for you, where we will talk about the types of SIPs, how to you step up your SIPs, and how to timely increase your SIP if you are an investor looking at valid market conditions for yourself as far as your investment goals are concerned. Let's discuss all of this. I have with me Mrin Agrawal, founder, director, FinSafe. Mrin, hi, good evening and welcome to the show. One more session of investor education, and today a very basic one and a very crucial one on systematic investment plan. As we all know, SIPs or SIPs, okay? You guys, even on platform like The Money Show, we've been talking about the power of SIPs, the power of investing in smaller amounts and then reaching a higher corpus or a larger corpus, which is aligned to your financial goals. But Mrin, a lot of people are still not aware of the kind of SIPs, regular investment that's been preached about, and a lot of campaigns that we've been seeing coming up also talk about regular investment. But apart from that, also there are various types of SIPs that an investor can look up to. A regular investment strategy is could be for someone who's a first-time investor or who's a regular investor, but then if you're a slightly mature investor, there are different type of SIPs that you can opt for. So let's deep dive into this, and let's start with types of SIPs. Mrin.
So good evening, Kavita. Yes, there are 7 different types of SIPs. The first one, of course, being the regular SIP, where you invest every month a fixed amount. And this amount could be done on a monthly, bi-monthly, quarterly, or half-yearly basis. And you have the option to choose the date. You have daily SIP and you have weekly SIP as well. So you have the option to choose the date of the SIP. So that's the simple one. The second one that you have is the top-up SIP. So as the word connotes, it basically means that you're allowed to increase the allocation into the SIP on a periodic basis. So for example, on a yearly basis. So for example, like right now, if you have an SIP running for 10,000, you can say that I would like to top it up by 10% every year. And what it means is that after 1 year, your 10,000 SIP will automatically start becoming 11,000 is what's going to start getting deducted, right? Then you also have flexible SIPs, and flexible SIPs allow you to make some changes to your SIPs. For example, you could, decide to increase the amount. You could decide to reduce the amount based on various factors. So for example, if you feel that the markets are down right now, you could say, okay, I want to put in more money. But if you feel that maybe you have a liquidity issue, then you might say that I would like to decrease the SIP amount. The only thing to keep in mind out here is that whatever changes you intend that you want to do, you need to inform the fund house 1 week prior to the SIP date, right? Now you have the most interesting one, which is the trigger SIP, which a lot of people are asking about these days, considering the markets that we are in, which is in trigger SIP. An additional amount gets triggered into the SIP based on certain conditions happening. And this trigger could be price-based, time-based, or value-based. So, valuation-based. So when you're looking at price-based, it means that you say that if the NAV crosses an X amount, let's say you say that the NAV crosses 1,000 rupees, then I would want the trigger SIP to start, right? So basically only when there's a trigger, and if the NAV falls below that particular trigger amount, so as I said, 1,000 rupees, if it falls below that, then you will say that you want additional amount to be put in. In time trigger, for example, people could say that they want to invest a lump sum amount on the market correcting a particular percentage. It could be 5%, it could be 10%. So they can define that. The third one is a valuation-based trigger, where based on a certain valuation parameter, for example, PE ratio. So if the Nifty or Sensex or a particular benchmark index falls below a particular valuation level or threshold, then they want to increase the SIP contribution by a predefined amount, right? So there are various factors in this. Of course, you have perpetual SIPs, which are for perpetuity. You can redeem them anytime, but they don't have a fixed tenure. And then you have multi-SIPs, where in one fund house, you can sign up for multiple funds at the same time. And so that's very convenient in case you have decided that you only want to do with this particular fund house all your SIPs. And then finally, you have SIPs with insurance where you have a term insurance cover. Each fund house has it differently. I think, some of them give you 10 times the first SIP amount and then it increases. Of course, all of them have a cap on the amount of insurance, which I think is typically 50 lakh rupees. And it's a term policy. And of course, this feature is available only on equity mutual funds.
All right. So I also want to understand, along with having a regular SIP, because that is what a lot of people prefer, along with having a regular SIP, you think investors can also opt for these other kind of SIPs that you just explained, Mrin? Is it possible?
Yes, you can.
Okay. And how would you strategize that?
So I think, what, firstly, everything depends upon 2, 3 factors. Of course, we're assuming that everybody has time horizon. But I think it also depends upon the sort of risk that you want to take and how active you really want to be. So for example, like since a lot of people are looking at trigger SIPs at this point in time, right? I think, basically trigger SIPs work well for people who are aware of market dynamics and who want to really look at this as a tactical allocation that they want to do into the markets, right? So I think it's kind of meant for more evolved investors, the trigger SIP. Of course, I think, top up SIP is something that everybody should have on their regular SIP because, with the top up SIP, when you actually increase the amount that you're investing every month, you're actually, in a long period of time, due to the compounding factor, you're going to see a very good growth in your investment, So just to give you an idea, for example, if you're doing 25,000 rupees SIP per month for 10 years, and we are assuming a 12% return, then in a regular SIP, you've invested 30 lakhs and your value is going to be somewhere around 60 lakhs after 10 years. But in a top up, let's say if you say that I'm going to increase this amount by 10% every year, then you have invested somewhere around 48 lakhs, but the amount that you're actually going to end up with is also much higher, around 85 lakhs, right? So I think, some of these SIPs are really good in helping you increase your corpus, right, in an easier way, like the end corpus in a way that's easy for you to do as well.
Let's also talk about certain kind of myths, that revolve around SIP. So I first want to understand that are there specific dates on which you can do SIPs, or there's nothing like that? It's just a myth.
Yeah, I mean, you can do daily SIP, you can do it on 1st, you can do it on 10th, yes, you can do it on 25th and all. But when you look at the historical data, it doesn't really matter, I mean, I think, especially people for daily SIP, I'm not in favor, I think it's like too much of, trying to basically trying to do too much of risk management.
Mrin, also I want to understand the tax related implication, because what happens is you have a tax attached to your investments. You are investing in equity mutual funds or investing in debt mutual funds. Even in equity, if you're investing in an ELSS, you have a 3 years lock-in. How does the tax implication work on your SIP across these categories?
It works on a FIFO method, which is first in, first out. So whatever you invested first, whatever's in a chronological manner, whatever you invested first is going to be taken as the first set of units that's going to be redeemed at the time of, when you're actually trying to calculate capital gains.
Okay. Mrin, could you also explain us a small difference between a lump sum and an SIP investment?
Yeah, sure. And also, just adding on to the last point, like in the ELSS, many people believe that there's a 3-year lock-in, but there's a 3-year lock-in from the date of the SIP. It's not like PPF where, you keep investing and then you have one final maturity date, right? So every date that you do the SIP, there's a 3-year lock-in from that date. And again, even for the regular schemes where which are where the long-term capital gains kicks in after 1 year, right? So 1 year from the date of investment of each installment is how the tax gets calculated. It's a little complicated, but honestly, the capital gain statements are available from the registrar and transfer agent, so it's not going to be that difficult for investors. Now, where SIP and lump sum is concerned, lump sum is basically investing a fixed amount every month. I'm sorry, if lump sum is actually investing a fixed amount one shot, whereas SIP is investing a fixed amount every month into a particular mutual fund scheme. It could be equity, it could be debt. So the difference is really about, can you really invest all that capital right now? Or would you like to do it over a period of time?
So that will be all about benefits of doing SIPs and most importantly types of SIPs, and not to forget, I think you might want to stress on this, no matter the volatility in the market, one should not be stopping their SIPs. Yeah, Mrin?
Yes, yes,
Last
yes,
word on that?
absolutely. Yes, yes, I think absolutely. And, again, it's not, I feel that, I would like to reiterate that a top up is something that everybody should look at. But, the rest of the SIPs, right, it really depends upon your convenience. Again, perpetual SIP works because, there are cases where people forget to renew their SIPs. And of course, flexi SIPs provide you some convenience, and so do multi SIPs. To be honest, I'm not in favor of SIPs with the insurance plan because of the fact that the term insurance cover is going to be there only till the time that you're invested in that particular fund. So I think you're better off taking a longer term insurance cover outside and then doing your SIP. Of course, that's going to cost you. Here it's coming free of cost to you. But I think the main thing to remember is that if you still find it difficult to do all of this, the regular SIP is good enough.
That will be all. Thank you so much, Mrin, for being on the show today and helping our viewers with various aspects of doing an SIP. And on that note, also, let's slip into a short break. But then before I get into a break, I'm going to... Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and time for our viewer queries. And for that, I have with me Anil Rego, founder, CEO, Right Horizons. Anil, good evening and welcome to the show. Let's take Dheeraj Kumar's question from Himachal Pradesh, and he has sent us his portfolio details, which has a Parag Parikh Flexi Cap. He's investing 3,000 rupees via SIP, Mirror Asset Tax Saver Fund, again 2,000 rupees SIP, Canara Robeco Small Cap Fund, 2,500 SIP, PGM India Mid Cap Opportunity Fund, 1,000 rupees SIP, Tata Digital India Fund with 1,000 rupees SIP. Total amount of SIP that's going every month from him is around 9,500. The target is to have 2 crores after 20 years. So we don't have him on the phone line, but as per the details, the fund selection looks balanced to you, well diversified. Anil, what will you say?
Yeah, so I think he has a combination of, with flexi cap, as well as I guess he has his requirement of tax savings. So he has a tax saver fund and also the mid and small cap. So I think there is a bit of a diversification there. The only one that I can point out is, he also has a Tata Digital India Fund. It's a sectoral fund. So if somebody is investing in a sectoral fund, I just wanted to point out that you need to keep in mind that you have to be a little more active. So you have to keep track of the sector. The sectors they come in, come out. Typically, that's a job that a fund manager does. And so if you have a good perspective of sectors, then you can sort of invest and do. But otherwise, I would suggest, stay with diversified equity funds. That's the only observation that I have out there.
All right. Talking about tax saver funds, Anil, how can one actually identify which is the right one for them?
Yes, so you have to look at various parameters. I think definitely one thing that everybody looks at is performance. There, I would say that while you're looking at performance, also look at not just say 1 year, because many a times, say short terms like 1 year, are too short to look at, consistent performance. So I would look at a combination of maybe a 1 year, maybe a 3 years and 5 years. 1 year is still important because, it will tell you whether a fund is, changing in dynamics, right? So if suddenly something comes right to the bottom, then you hold back on investing in a fund, let's say, of a 1 year perspective. But otherwise, I would look at, say, a 3 or 5 year. I will also look at risk measures because, it'll also give you some perspective that, how the fund is doing. Measures like Sharp, which also give the risk adjusted return, are ones that you can do in risk. You can look at the standard deviation and other measures out there. So, so combination of maybe risk return and the fund house longevity as well. So if if you have consistent funds across segments, then you can say yes, it has been consistent. The track record of the fund managers, with a lot of other qualitative aspects that you have to look at, while doing so.
All right, Anil, let's move on to our next question. Let's take Saundar's question, and he's ready to invest 1 lakh rupees per month in mutual funds for at least 8 years. The investment that he's doing is for a corpus requirement of 5 crores, and he wants to understand the fund mix that he can have in order to achieve this corpus in 8 years.
Yeah, so I would think that he is being a little aggressive out there because the time period is shorter. You're saying in about 8 years, a SIP of let's say 1 lakh will probably give you a corpus of something like 1.6 crores, right? Assuming a 12% return. So that's something that sort of one keeps in mind. So he will be short of his objective of say achieving a corpus of 5 crores. Now the question is, what is it that he can do? Right, to be able to achieve that corpus? He can do two things. One is, he'll have to significantly enhance the monthly contribution upfront, which may not be as practical and possible. So, but it may make sense to look at, can I say from 1 lakh, say increase it to 1.25 or 1.5 lakhs, based on the ability to look at it right now. The second thing one can do is, if he increases his SIP by 25% year on year, which is a bit of a tall ask, right? So then he will be able to achieve his 5 crores in 8 years. So I would think maybe a more practical one, if you can do a combination of both. You increase the base itself a little bit as of now, as much as possible, and then you can do with a slightly lower year-on-year increase. Now, what are the funds that he can invest into? I don't have perspective of, let's say, what is age profile, risk profile, etc. So I would suggest diversifying across various categories, like let's say the large cap. You can see a fund like say Nippon India large cap, or even an ICICI blue chip. You can also look at on the mid cap category, say a HDFC mid cap, or a Magnum mid cap fund. You can look at a flexi cap, which is the HDFC flexi cap, in the flexi cap category, and multi cap, which is Kotak multi cap fund. Now the distribution of this will depend a lot on what is his risk profile. This is why I cannot give what are the percentages you can do right now. But if you're a lower risk profile, then focus a little bit more on large caps and flexi cap funds. But if you can take a higher level of risk, then you can actually go and have a little exposure to the mid caps and even the small caps as well. So that's a broad outline of maybe how we can achieve it.
Last question, Anil, and let's focus on this. Darshana's question. She wants to know what are the top ELSS funds that she can invest in, and she is 25 years old.
Yeah. So broadly, I mean, here at least it's clear that she's young and she can take a higher level of risk. Of course, ELSS funds, just to give you a perspective, they are 100% equity funds. So from that standpoint, because of her risk profile, I think she can also do it. So I would suggest looking at a long-term track record, and two funds that I would suggest, let's say an SBI tax saver as well as a HDFC ELSS tax saver. I think a combination of these two funds is what she can do, not just to one fund, because you don't know how the fund is going to perform in the future. So ideally look at least two funds for your investment.
All right, that will be all. Thank you so much, Anil, for being on the show and helping our viewers with their financial portfolio queries. And time to wrap up, but then I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your questions. You can WhatsApp us your question. You can also send us via email. The email ID is themoneyshow@etnow.tv. The WhatsApp number is 8657974571. And see you tomorrow. Thank you so much for watching. Goodbye.